If you're considering selling your home in this hot market, don't forget to think about the taxes that might eat that profit. Hey taxpayers, Tiffany Gonzalez CPA here with a topic that might surprise a lot of homeowners. When they go to sell their home, they might have tax implications. Selling your home is a big decision, and the trickiest part is the basis you have in your home. Tax basis, what is that? Let's get into it. When you sell your home, the IRS uses your basis to determine your capital gain. For example, if you sell stock for $150 and you originally purchased it for $100, your basis, you have a capital gain of $50. Your basis of $100 that we just talked about is a key important number to understanding that equation, arriving at your capital gain and thus arriving at your capital tax. So knowing your basis in your home is going to determine how much profit you are getting from your home for tax purposes. So Tiffany, shouldn't the basis of my home just be what I purchased it for? You see, a basic CPA might say that, but calculating the home in your basis is much more strategic than that. The purchase price. Yes, we definitely start with the purchase price, how much you paid for the home. But then we need to add and subtract certain things. What do we add? We add improvements you may have made to the home. Think of major renovations. Did you redo your windows? Did you redo your roof? Did you redo your kitchen? And then we subtract certain items. This might be something like depreciation. Did at any point you depreciate your primary home for any given reason? And if so, subtracting that from the basis. So really, the formula for your tax basis in your home is purchase price plus improvements minus adjustments like depreciation. So let's do an example. You purchased your home for $200,000 with closing costs of $5,000. You're in at $205,000. You then decide to renovate your home while you have it, and you spend about $20,000 on a new roof. You're in for about $225,000 at this time. $20,000 plus the original purchase of $205,000. You've decided at some point to rent your home out for a short period during the 20 years that you lived there, and you depreciated it during that time in the amount of $10,000. We would then subtract $10,000 from your basis. So we would take the $225,000 minus the $10,000, and your final remaining tax basis on this home would be $215,000. So when you go to sell your home, you would take the sales price minus this adjusted basis calculation to arrive at your capital gain. And at that point, we would apply the tax rate for the capital gain in order to figure out what your capital gains tax is. This is why it's so important that throughout the lifetime of the property you own, any property you own really, personal home or investment, you should always retain copies and receipts of any renovations you do over time. You see, when you own a home for 10, 20, 25 years, you might not have the receipts later on when you go to sell it. But if you're really good at record keeping, this will allow you to have the best, most lucrative tax basis possible in order to avoid as much capital gains tax as possible. Now, this is a simplified overview, and there is a personal home exclusion. So this is an amount that you can exclude from the sale if you've lived in the home for a certain amount of time. And we did a video just for you that we'll link over here on YouTube. But it's really important that the year in which you sell your home, you seek a qualified CPA to do your tax prep, because they will know all the ins and outs about how to get to the right tax basis to minimize and reduce your tax liability as much as possible. Hit the like button, subscribe to our YouTube channel, follow us on LinkedIn, Instagram, and Facebook at Accounting to Scale. Until the next video, your favorite CPA, Tiffany Gonzalez.